Hello everyone, good day. I'm going to discuss about capital budgeting. Capital budgeting is basically allocating resources of the company or business geared towards long-term perspectives. That's why this is going to be strategic in nature. So we think of long-term horizons, say for example, more than 5 years. So that's why the budgeting here would require massive and intensive investment wise, like this would cost millions and billions of certain currencies, either pesos or dollars or whatnot, or whatever. Okay, so capital budgeting as it is, and let's discuss it. So capital budgeting, as what I've said, is strategic in nature. And then this poses the decision process that we think about. And this involves three basic steps. Number one is we think and generate and create or draft a long-term investment proposal. So what are we talking about? What are the details involving that particular investment? Then after that, it will be forwarded perhaps to a certain department in charge for this or analysis, or probably a superior or supervisor. Then the review, analysis, and selection from the proposals that have been granted. It's very important to review because for all we know, there are certain items there that are not related or irrelevant to our project. And then we need also to select, since we all know that the company has limited resources. So we have to make sure that those investments that would result or produce the biggest margin or addition to profits or coffers of the business should be given priority or should be implemented first. Then, as what I've said, implementation. So implemented was the word a while ago, and monitoring the proposals that have been selected. All right, so if you are going to analyze with the three, it begins with planning, then we do the analysis, the selection, etc., and we implement. So we have to consider investment and financing as two different things and decisions. So investment is for the long term. We think of assets that would produce more assets to the company, so revenues for that matter, while financing would be different because financing would talk about getting sources of the resources for the business. So where will we get the money in order to finance our investment? So shall we issue bonds? Shall we borrow money from the bank in a long-term horizon also, or perspective, which is normal? Or should we issue shares, either preference or ordinary? So those things, that's why investment is clearly separate from financing. Investment is under non-current assets or will focus, while financing will focus on the opposite side, the credit side, either liabilities or debt or equity. I hope that is clear. Next, so here are some techniques that we are going to discuss as we go along the way in detail, but they are differentiated here. So accounting rate of return is a certain ratio that would focus on the profits, accounting profit. So basically the profit or loss that we have learned from our accounting subjects. Next is payback period. It is most commonly used, oh, that's not the definition, but the definition is that it is the amount of time, it is the period in which a particular investment can be recovered through cash flow. So payback period would focus on cash flows, and majority of the discussions, if not all, yeah, there's an exception here, ARR, would really focus on cash flows, since financial management is very particular with the usage of the cash of the company. ARR is more on the profits, that's accounting. Next, net present value is basically the margin of the cash flows of the company's present value or project's present value less the cost of that investment. So when we say margin, that's the additional or extra amount. Next, internal rate of return is basically the return in which that is to be estimated or interpolated, wherein this is the rate in which the cost of the investment would equal or would equate to the present value of the cash flows or net cash flows of the company. And finally, we have the Profitability Index or the PI, and this relates to the net present value. For PI, this is going to be focusing also on the cash flows. So among the five, it's only ARR that would focus on profits. Okay, next slide. Oh, okay, next slide. A capital budgeting process should, number one, we have to account for the time value of money. If it's a time value of money, a peso that is saved today is worth more than the peso to be saved tomorrow because of interest rates and the interest that would be earned on the money. And then the analysis would disregard unemployment rates, the inflation rates, among other rates that we have known in microeconomics and macroeconomics. So basically the focus here in TVM or time value of money is on the interest. So the growth of the money. Next, risk is to be considered. In our business perspective, the more risks there are, then the greater rewards there would be. So the higher the risks, the higher the return. So meaning there is direct relationship between the risk and the reward. So for us to have more benefits and rewards, we need to embrace more risks. And risk is going to be a component in computing our discount rate. So in problems, the discount rate, so I repeat, risk shall be included in the discount rates. But in our problems, the discount rates anyway are given. But if this is like the real life, we also have to account for the risk. Then cash flows, which are very important. Our inflows, meaning the plus of money. So the money that would come into the business, while the outflows would be the minus. The net cash flows would be very important to consider. And then we rank competing projects appropriately. As said, the company has limited resources or sources of money. So that's why among competing projects, we need to rank them so that the most profitable one should be prioritized. And then finally, whatever decisions that would be made, then overall it would maximize the shareholders. So this would be the primary objective of financial management. So if you will be asked, what is the primary objective of financial management? That is to maximize shareholders' wealth. Because as financial managers or as part of the managers of the organization, we always think about what would increase the wealth or the share price or the cash flows of the shareholders. Because if the shareholders are happy, then the more that they are going to place their monies to the business. Okay, so we have an example. We have Global Wireless. It is a worldwide provider of certain wireless telephony devices, and then contemplating a major expansion of its wireless network in two different regions. So you have here the Europe expansion, that's Western, and a smaller investment in Southeast United States to establish a two-hold. All right, so meaning expansions, major expansions are to be made and considered. Then here are the details. So for Western Europe expansion, you can see here the outlays. So this is the initial investment and the inflows. The plus, this is the minus, and these are the pluses, additions that would be brought or generated to the company's coffers. And then for the Southeast US to hold, so this is the initial investment, and these are the inflows that are to be considered. So let's think. We have accounting rate of return. So the formula is average profits after taxes, meaning whatever is the net income, that would be net of tax, or even the loss, but then this is like rates of return, so we think of profits. Then the average investment. So the word is average. Therefore, we have to consider, like for 2 years, we divide that by 2. Then this need only profits after taxes and depreciation. And then average profits after taxes are estimated by subtracting average annual depreciation from the average annual operating cash inflows. So if we think of the statement of cash flows, there are 3 activities. We have operating, investing, and financing. So under the operating activities, whatever would be the cash inflows, we deduct the depreciation. That would be our average profits after taxes. Okay, so I said here, from the average annual operating cash inflows. So if we think of it, if we are going to analyze this accounting wise, so the movement is from accrual, average profits after taxes accrual to cash basis, or the reverse, from cash basis to the accrual. Remember, the depreciation is a non-cash expense. So this can be deducted just to get the average profits after taxes. Well, anyway, if, for example, we are using the given, for example, profit, remember we are going to add back the depreciation because it is a non-cash expense to get the average annual operating cash inflow. So by that, we can manipulate the formula. So average profits plus depreciation equals the average annual cash inflows. So if we manipulate the formula, we will get this one. That the average profits, the result, or that amount is the result if we deduct average annual depreciation from the average annual operating cash inflows. Okay, so as I repeat, profits average plus depreciation equals cash inflows. Therefore, the average profits is equal to inflows minus depreciation. Okay? Then, okay, here we go. There's the formula. That's what I've said. So basically, this formula is the manipulation of the one that we have known under statement of cash flows, that average profits after taxes, in which that is deducted already with depreciation, but it's not cash expense. So that's why we add it back to get the annual operating cash inflows. Okay. And that's the disadvantage of ARR, because ARR uses accounting numbers, not cash flows, no time value of money. So for this one, the numbers are in accounting, and then they are not cash flows, meaning the cash flows are not considered here. You can just notice here the numerator is profits after taxes, and it does not make use of interest rate. So the interest rate is on the time value of money. Next is payback period. As what I've said, it's the amount of time by which the firm or company would recover the initial investment. So how do we analyze if, for example, this is the case? The analysis here is that if there is a standard for payback period that is acceptable, so if it is less than that or equal, then we are going to accept the project. Example, the standard is 3 years. And then when we computed the payback period, it is 2 years, meaning that is acceptable. If equal to 3 years, still acceptable. But if the payback period exceeds 3 years, then we are going to reject the project. So that's the summary of the two. And then management determines maximum acceptable payback period. Here is the analysis or example. So cut off, this is just given 2.75 years. And then initial outflow, if you can recall or remember that part there, which talked about the outflows, then the first project has $250 million. That's negative. The cash inflows is only $245 million. So what's basically the formula to compute the payback period? That is, remember, the amount estimated for the investment to be recovered. So that will be the amount of the particular investment. So the cost of investment divided by the inflow. So can we go back to that part, please? Okay. All right. So here it is. There. So if you can notice, you have here the investment and you have here the inflow. So if you are going to compute that, the total like inflows, of course, would be different with the outflows. We want that our projects will be having a margin on top of the cost. That is always our target anyway. Although that may not be happen all the time. So how do we compute the payback period? In this case, guys, what we can do is that we can compute this by looking at the inflow. So if the given inflows are still lesser than the total amount of the investment, then we are still going to continue up to such time that the total inflows would equal, or let's say close to equal, or let's say the total inflows would be higher or close to the total amount of investment. So how do we translate that into computation? For year one, that's $35, right? So that is still beyond 250. So we count that as 1 year. Meaning for every inflow that is still below, especially the total is still below the total amount of investment, then we are going to continue our analysis. For year one, that's 1. Year 2, that's 35 plus 80, that's 115. So still below 250, that's still going to be a 1. Year 3 plus 130, okay, so 245. That's going to be another 1. So there are 3 years now. Since the total is 245, so I repeat, have 1, 1, 1. So we get the total of the inflows. Cumulative total inflows would be lesser than the total cost of investment. And with that, we still have to continue our analysis. 245, that is just lacking $5. So we continue our analysis to year for 5. And then we stop there. Otherwise, if we add 245 plus 160, that's 405. That's already way, way beyond 250. So just get the portion or the difference. So that's $5 to equate to 250. 5 divided by 160, that's the fraction that we can compute as the fraction also, or the decimal or the point for the payback period. So that's 0.03. If we divide 5 divided by 160, that's 0.03. So meaning it's 3.03. That's the payback period for the first project, which is Western Europe expansion. Okay, so if we go back to that analysis, that's why it is said here that we will have to reject the project because the payback period is 3.03. I think it is rounded off into 3, which is greater than 2.75 standard. So reject the project. All right, what about for Southeast US project? Let's go back to that example again. Let's compute. So knowing the first for Western Europe, okay, so for those who are here with me and listening, then you can pause this one and try to solve for yourself, knowing the details a while ago. So that's what I've said. We are going to check the cumulative total cash inflows if they are going to be close to the amount. And then the amount is the investment, of course. And then for every year wherein the inflow is not yet equal to the outflow or outlay, then we are going to count out or count that for 1 year. All right. So for year 1 inflow, that's still 18, meaning that's 1. All right. Okay, this is your time to pause, or you should have paused prior because I am going to discuss it now. And then that's 18. Year 2, 18 plus 22, that's 40. So you count 1, another 1 for year 2. Oh, and that's 50 total investment, meaning let's check if the year 3 inflow is higher. That's 25, so meaning it's within there, right? We should not go beyond because that's going to be way, way above 50. So 18 plus 22 plus 25, that's 65, meaning stop at 25. And then the remaining amount for the 40 to equate to 50 is 10, right? So 10 divided by 25 is 0.4. Therefore, the payback period is 2.4 years. Let's check that. Let's check that. Okay. All right. So that's why it said here that it is 2.4 years. And our decision, Judge, that is to accept the project because the payback period is less than the standard or cutoff for management. All right. So this is for payback period. What are the pros and cons? If you say pros, we think or talk about the advantages or the positive sides, whereas if we say cons, we think of the negative aspects or things or downsides, in other words, of the payback period or method. For advantages, it is simple, yeah. The computation is simple, or let's say it's going to be easier compared with the others or other ratios. This is, by the way, the second method, of course, easy to understand, yeah. So just compare it with cutoff after computing. If it is lesser than the cutoff or equal, so accept. If it is more than the cutoff, then reject the proposal. And it focuses on cash flows, which is the setup and the concept and the focus in financial management, focus on cash flows. On the other hand, what would be the disadvantage or downside of payback method? Time value of money is not accounted, no discount rates, no present value computation. It does not include risk, right? Risks are not included on the computations in the sense that there are no discount rates that are supposedly to carry with such the impact of risks. And cutoff period is arbitrary, meaning it's a ruling, it's a decision. So that's it. Like we cannot do anything about it anymore, right? So it's, for example, a quantitative method, right? So if we qualify with other things like qualitative, then that's going to be like the very, or it's going to be debatable, in other words. So there are many things to consider. By the way, in financial management or in our analysis, we think of the quantitative factors and the qualitative factors. So we think of the numbers, quantitative, and we think of the descriptives or words or narratives, qualitative. For this discussion purposes, we think of the numbers because it is easier to analyze using numbers. And that is true here. That's why it is a disadvantage, because what if the item qualifies under qualitative? So there are like surrounding additional benefits, just not the numbers that would satisfy. But because of this ruling, so we have to really follow it. If we would like to pursue the project, so a lot of debates can happen, or defense, or defend on the item to the management. And normally management would like disapprove, if not final, then initial, because of the ruling of payback method. And then it does not lead to value maximizing decisions, right? Because time value is not considered, risk is not considered, although it focuses on cash flows. All right, hopefully that is clear for payback method. Next is discounted payback. As opposed to payback, the cash flows are just discounted using the rates. So hopefully we have known this already in our management subjects like investment subjects. So some would be perhaps on your other subjects, could be other financial management subjects or courses talking about this one. But I'm pretty sure mathematics of investment has discussed this a lot of times. So in addition to what we have learned with payback method, all we have to do is whatever would be the cash flows, we just have to discount it using the rate. And the discount is the rate raised to the power of negative time. So if it is like year one, so whatever is the rate, then we have to consider that. All right, so it will be the so-called PV of 1. 1 plus the rate enclosed in parentheses to the power of the negative period or year. So if it is like 18% for year 1, then that's going to be 1 plus 0.18 enclosed in parentheses to the power of negative 1. If it is 2 years, then, or the year 2 or second year, that would be 1 plus 0.18 to the power of negative 2, and so on. Whatever is the result, you multiply that with the cash flows. So that's what we can do before we are going to analyze or following the steps that we have known of. All right, so let's think about, this is not, okay, it's another topic, net present value. So we have to go back once again to that particular example. Okay, showing the details. Here it is. So if we can just insert it here so that it will be easy for us. All right, so we can just go back and forth. Okay, so right, here it is. If we can just look back to this one, that's 35. That's year 1 for Western Europe expansion. So 1.35 to the power of negative 1, right? That's going to be how much is that? So 1.18 rather. It's the rate is 18%. Okay, so 1.18 to the power of negative 1. So that could be 0.847458. So 6 decimal places, or you can copy everything. So, or use everything that comes out with your calculator. Times 35, that's 29.66. Let's check. 29.66. But here, 1 decimal place. So that's why it's 29.7. Okay, so that's it. Just continue. So for year 2, 1.18 discount rate, that's 0.718184 dot 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 times 80. So that's why we get 57.45 or 57.5 here. Second one, that's the present value of cash flows. Okay, and for year 3, okay, 1.18 to the power of negative 3. Since the two projects have the same discount rates, probably because they are of the same type of investments or nature of investments, so they used or utilized the same discount rate. As what I've said, this discount rate would be in capturing or including or would be taking into account the risks involved. So whatever is the rate, we just have to use that. Then going back, for Southeast US 2 hold, what we can do is that whatever was the computed 1.18 to the power of negative 1 should be multiplied by 18. Negative 2 power is here and negative 3 power is here, and continue up to the 5th inflow. So that we will be seeing this here, the summary. And then what we can do now is get the cumulative PVs. So how do we compute the cumulative? Simply add whatever is the PV of that particular year and prior. For year 1, obviously the cumulative PV equals to PV of cash flows because the prior year is 0. So 0 plus that equals the number. Any number added to 0 equals the number. And we do the analysis now. So the analysis is that similar to payback period wherein whatever was the total amount of investment, we count for 1 year for the cash flows of that year for as long as the cumulative PV is not yet equal to that cost of investment. And we continue up to such time that we get a cumulative PV higher to that value. And if it goes higher to that value, then the remaining or the remainder of the payback period, the point something, is simply the remaining amount of PV of cash flow that would equate to the cost of investment divided by the PV of cash flow of that particular year. Okay, so let us do that in figures. So for year 1, it's 29.7. That's very high. I'm talking about the investment. The investment is very high. So that's $250. It's negative, by the way, in the sense that this is investment. Inflows are the process. But then, of course, we can just take them into positive, right, as investment. Okay, so that was just being done in negative or with negative for emphasis that it is an outflow or outlay. Okay, so here it is, 29.7. That is what, 1 year. That's counted as 1 year. Then for year 2, that's the 1 year. That's 87.1, less than $250 million. For year 3, oh, that's 166.2. That's below 250. So 1. Year 4, count 1. Okay. And then year 5, 248.8, that is very close to 250. So for us to be close to 250, 250 minus 248.8, that is 1.2, right? And because at year 5, year end, we already exceeded that 250, meaning that's a stopping point. So that is the time that there is a fraction, meaning that's going to be the point something of the discounted payback period. So that is 1.2 divided by 76.5, and that is 0.02. Therefore, the discounted payback period is 4.02. And then knowing the cutoff of management, which is 2.75, so clearly we are going to reject the investment. Okay? Reject the investment. Next, what about for Southeast US project? So year 1, 1 year. Year 2, another 1. Year 3, another 1. Then year 4, another 1. Year 5, oh, so up to year 5, that's still 75.7. But how much was the investment prior? That's 50. Okay, so 50. In that case, we will stop at year 4, right? Year 4 in this situation. So always go back. We have to go back to the amount of the initial outlay or investment in this particular case. So year 1 is 1. Year 2 is another 1. Year 3 is another 1. And we are very close to 50. So 50 minus 46.3, that's 3.7, right? So a while ago, I said like 1 up to year 5. If ever, the amount really is higher than 75.7. Okay, which is quite something to think about. Like that investment would really be beyond your projection. So normally that wouldn't happen though in problems. So it should be within the provisions or the given items in the problem. So we will know that we are like able to overlook something. Going back. So 50 minus 46.3, that's 3.7. 3.7 divided by 15.5, that's 0.24. So year 1, that's 1. Year 2, that's another 1. Year 3, that's another 1. And year 4, that's 0.24. So 3.24, right? Yeah, so 3.24, meaning 3.24 is lesser than 2.75 or higher. It is higher. Therefore, reject the investment. So see, that's the impact of taking into account the discount rates. Because a while ago, if we just follow the payback period analysis, then our view or point of view would be very limited. So we'll just accept the Southeast US project. Of course, the Western Europe project is still rejected. Then Southeast US project now is rejected. That's the advantage of discounted payback method. Okay, hopefully that's clear now. Then another one, the fourth one is net present value. The net present value basically is the sum of the present values of a project's cash inflows and outflows, or basically whatever is the present value of the cash inflows less the present value of the outflows, which is the cost of investment at time 0. Therefore, the cost of investment is not discounted because it is there at the time of the start of the investment. So at time 0 or the start of the project or proposal. Next, we also do discounting here. We appropriate the discount rate, or we choose discount rate accounts for risk. And that's why we can see here the mathematical formula that the net present value is basically the sum of the cash flows at time 0 and at the end of each year or years, depending on the estimates and assumptions. And then CF stands for cash flow. So cash flows at time 0 or cash flow at time 0 is the investment, because that is the value that there is and has been paid by the company at the start of the proposal. And then the cash flows will have to be discounted because we will estimate it at the start of the project or time zero, but they will be earned year or years from now. So we compute the present value. Let's say the amount at year one is 100,000. So what would be the value at a certain rate of it now or today? That's the present value. In this case, we have to accept the project if NPV, the net present value, is greater than zero. Of course, we have to have a margin. So there has to be an additional amount or benefit to be given to the company. So that is still the formula. Discount rate is very important because that's the minimum return that the project must earn to satisfy investors. Of course, we can also connect the relationship here of discounting, that the higher the rate, the lesser the cash flows that would be there. So that's why if ever we would like to have higher net present value, then there should be lesser discount rates. With lesser discount rates, that would imply lesser risks involved in the project, right? If lesser risks, then there would be, of course, the higher chances for NPV. However, remember, this is going to be the trade-off, because if there are like lesser risks or lesser rewards, the more risks, the more rewards. So that's why it's going to be a case-to-case basis though. So the key here is that if rate-wise, you want it to be lower. But if we have higher rates, so cash flows would help. Because the higher the cash flows or amount, at least we can still compensate the impact of the discounting. Okay, I hope that satisfies the question or the query, because that can be asked. Like, how can we increase NPV if we lesser the rate? But if we embrace lesser rate, so we will be not following the concept that the higher the risks, the higher the returns. Of course, you want also to manage risks, that as much as possible, the risks should be those that are manageable. And if ever we can have like risks that we cannot eliminate, so at least those that can be minimized or managed will be at minimum level. So that will be discussed more in other topics, like the risks involving those that can be managed or not managed. And then if ever would like to have more NPV or higher amount, then we can just compensate that with the higher cash flows of the project. So it's like if we have higher cost of investment, normally we also have higher amount of cash flows, supposedly. Although this would depend on the situation. Then R or R varies with the risk of the firm and or the risk of the project. So R represents the risk in the project and also the return, because risk equals return, right? That's the concept. Then we have the NPV analysis. We have already computed the present values, if you can recall, in the discounted payback period, right? So we can just get the total of those. So let's go back to that, or let's copy it so that it will be close to NPV here. Okay, so here it is. If we just get the total, okay, it's given 325.3 minus 250. Okay, that's 75.3. Therefore, we will accept the project. So see, the decisions would change depending on the given items. Then what about for Southeast US project? 75.7 minus 50. There is a margin of 25.7. Therefore, we are going to accept also the project. And then should Global Wireless invest in one project or both? Both, if ever they have plenty or unlimited resources. But if they have limited, so it will depend upon which has the higher margin. So that's they are going to think or analyze, or that's where analysis would take place. All right. So this is the NPV rule and shareholder wealth. So if we are going to think of this. The price is $40. The rate of return is 10%. The expected dividends is $4 because remember the dividends that would be received by the shareholders would depend upon the price of stock. So this is like the R being the dividend over price. So 4 divided by 40 is 10%. So that is the dividend market ratio, right? The dividend market ratio. So 4 divided by 40 is 10%. All right, and then to continue, you also have here for another case, if firm invests, so the expected dividends using the same rate at 10% is $4.10. If NPV is greater than 0, meaning there's a margin. So the return is higher than the 10% that there is. And then if, for example, the NPV is lesser than 0, we can also notice that the dividends go lower because we have been experiencing loss or probably negative amount. So meaning there's a negative result when we deduct our cost of investment from the present value of the projected cash inflows. All right. So what's the lesson here? The shareholders' wealth should be maximized. Therefore, we should only accept the project that would be producing NPVs of higher than 0. So negative and 0 should be disregarded. Okay? So this is the analysis assuming that the R, the dividend market ratio, is constant. All right, that's the lesson of that graph. Pros and cons of NPV. NPV basically is the gold standard of investment decision rules. Clearly, it's like the cream of the crop. It's like the icing of a cake. So this is to be used really in analyzing. What are the pros or the advantages? Focuses on cash flows. So that's the good thing here. I said that out of our discussions, only accounting rate of return that would focus on profits. Then time value of money is to be considered or recognized, and risk differences between projects are there. But then what would be the drawbacks? It lacks the intuitive appeal of payback. Yeah. So if, for example, that's the payback, like it's easier to analyze that. That does not satisfy the benchmark, so reject. It satisfies the benchmark or lesser, then we are going to accept. And doesn't capture managerial flexibility option value well. If we are going to think of it, so the two projects are acceptable. So it would be easier for us to think of which one should be prioritized. It's not going to be easy. In other words, it's challenging or difficult. And payback period, remember, Southeast is to be accepted while Western is to be rejected. Okay, so that's why there is like option value that, oh, this is the one that is to be prioritized and so on. Okay, another one, this one is like the challenging part that a lot of students would think, but for us, we will just be talking about the concept. So this is the rate by which the investments cost, the CF sub 0, would be equal to the present value of all cash flows attributable to the project or proposal. And then we think of the cost of capital. The cost of capital basically is the discount rate, the risk that encapsulates the risks in the project or of the project. If the IRR is greater than the cost, we have to accept. So the cost of capital there, the IRR is greater, so probably accept. If less, then reject. That's how simple it is for that. But if we are going to do it in computation, it's going to be challenging because we have to estimate, we have to interpolate the amount of IRR, the rate of IRR. It's a percentage. Then that's why this is not discussed much in terms of computations in even in financial management subjects. We can even make use of our financial calculators if we have. That's not required here anyway, or we can also make use of softwares like Excel to compute IRR. So meaning in real life, it wouldn't be much of an issue. It's now more on the analysis. So we can just see here IRR. This is the intersection of our graph with the IRR. So what's the graph here? That's the question that we can. This graph shows on x-axis the cost of investment, meaning the risks incorporated in the investment, and these are the rewards, the dollars, so the cash flows, present value of cash flows, of course. Now, we can see here that if IRR is greater than the hurdle rate, the hurdle rate is the discount rate again in the project or the cost of capital. NPV should be greater than 0. Therefore, this increases shareholders' wealth. Then that's going to be accepting, or we will accept the project. On the other hand, if we go here below the cost of investment, this is like 0 to negative. The IRR is lesser than the cost of capital or hurdle rate. NPV is lesser than 0, and the project decreases shareholders' wealth. So this goes to show that it is easier also to analyze if we just have the rates with us, but IRR really is not that easy to compute if, for example, we really do massive trial and error, interpolation method. Like interpolation is trial and error, but we can also get close to that by applying, like if the rate is this one, 10%, so this would be the resulting present value of cash inflows. The guide is the cost of investment. We are close to it, like we are being really lower it. So meaning if we are lower it, we have to decrease our rate, meaning below 10%, so that the resulting amount would be higher or equal to the cost of investment, and so on. Up to such time we get close to it, and that's the time that we will interpolate the rates. Okay, then by interpolating, or after interpolating with the 18% IRR as acceptable, we got the following rates. Therefore, we are going to accept the two projects because they are above, obviously, with that 18% IRR. If equal, we'll also accept. What are the advantages? Time value of money is accounted, cash flows, yes, and then it's a number with intuitive appeal. So like, it's so easy to compare with the standard. This is like the payback method or period. Disadvantage, yeah, mathematical problems, massive computations, no real solutions. Yeah, it's possible that there will be multiple IRRs, like there are so many of them that would satisfy the particular case. Scale problem is when, for example, we get this particular IRR, which is this amount, but the amount of the investment is very low. Let's say it's 50, going back to that previous slide, it's $50 million here, but it's 36.7%, that's higher. If we have like limited capital, we will be prioritizing this one first, and the remainder would go to the Western Europe project, which is supposedly not the case, right? It should not be the situation here. I hope that is clear. Otherwise, what can happen is that if this is the case, so the Southeast project again would be prioritized than the Western Europe project. And that's going to be the scale or scaling problem. since some projects or project maybe have higher IRRs or even like most or more favorable payback periods. However, they have like lesser investments, therefore lesser risk. This one, Western Europe project, has 27.8% IRR, but the amount of the investment is $250 million. So that's the point here. And timing problems. So some cash flows are like bigger at the time that the present value factor is the highest. Example, earlier years. Can we go back to the sample then, just for you to visualize? Okay, this one. So I will copy this so that this will be close to IRR really. Right. Okay, here we go. So we can just notice here that the given cash flows at the early years are bigger here, right? In which the lesser the year, the lesser the n, the power, the negative power, then the higher the present value factor, the higher the cash flows. So it would be advantageous for a certain project wherein at early years, it has the highest or higher cash flows because that would result to higher present value of cash flows. So I hope that is clear. And that's the timing problem. So those two problems, scale and timing, would really occur or happen in different projects or proposals. Next, multiple IRRs would occur when it would be in multiple cases that the cost of investment is equal to the present value of cash flows. In fact, we can see it here, 10%, 20%, 30%. So that's the problem now, like no real solution because the three rates IRR is going to be there, or it's going to be resulting from our computations. So no clear solution, like which one is really going to satisfy the project. Anyhow, the point here also, despite multiple IRRs, that will be our guide that, oh, we will have to accept the project because the IRR given is higher than the discount rate. That's the good thing if like the three IRRs are higher than the hurdle rate or the cost of capital or the discount rate. But the problem is that what if like the rate here is 18%, so one IRR is lower rate. Of course, that's going to be disregarded. That's not going to be the IRR that we are going to follow in our project, only the higher values. But if there's like one lower, we'll be thinking that, oh, shall we accept or reject, right? Anyway, when project cash flows have multiple sign changes, there can be multiple IRRs. Yeah, that's true. The multiple sign changes can be, for example, like year one, there is this investment. Then there are cash flows at the end of year one. So year one, year two, and then at year three, of course, there's the cash flow, but there's like additional investment and so on and so forth. So this can happen. So which IRR do we use? In that case, let's check. Sometimes projects do not have a real IRR solution. Then modify global wireless's Western Europe project. That's the first project. There are two, the Western Europe and the Southeast US. To include a large negative outflow of negative $255 million, meaning additional investment in year six. Therefore, there is no real number that will make NPV equal zero, so no real IRR. So project is a bad idea based on NPV. At R equals 18%, project has a negative NPV, so reject. Meaning this would be our decision then that, oh, the project is bad because based on NPV, it has negative amount, so reject it. So that's, again, the conflict there. If we have like that situation, so multiple IRRs. A while ago, multiple IRRs, and example, as what I've said, which IRR do we use? It should be the IRRs higher than the given cost of capital, right? So in this case, it's 20% and 30%, but which one? It's going to be the closer amount or rate, 20%. For this one, no real solution. So we can just make use of the NPV then, meaning other methods. If this wouldn't work, like the IRR, use other methods like NPV, which is the golden standard, as we said. And I love also the color here. It makes this golden standard. Scale problem. NPV and IRR do not always agree when ranking competing projects, probably because of scale problem. As what I've said, some have more investments, costs of investments, and then the cash flows, of course, would be there, but then they would have lesser IRR. So we would be thinking that they should be considered second or next. So meaning not the highest priority. But then the other project which has lower cost or investment or risk, but with a higher or highest IRR will be prioritized first or on top of the list. So that's why if we are going to analyze NPV and IRR wouldn't always agree. In certain situations, NPV would be saying that the two should be accepted, but IRR would be saying that, for example, let's say one only or the vice versa. So they do not always agree. All right. So you have your IRR and PV. Okay, so this is the key here. This is lower, right, compared with the two IRR. But take note that Western Europe has higher investment, 250 million, and this one is 50 million. In fact, it is 5 times having an investment than Southeast US. So that's why if we look at the NPV again, it's even higher than the Southeast US. And because of the scale problem, we might be thinking that, oh, because under IRR, Southeast US has higher one, so we consider it. And that's why we will look into really the NPV. That's true. With higher RRR on Southeast US project, but it does not increase the shareholders' wealth that much if you look at the NPV than the Western Europe. In fact, it has cost of investment of 5 times than Southeast US. Okay, so yeah, I said, and then if we think of it, come to think of it, probably Western Europe has higher investment, meaning the market really there is big. That's why there is really going to be higher investment there. Or we can say that we will be placing more money there in Western Europe because of the market, meaning the market acceptability, the penetration is really good. That's why we are going to place money and put more resources in Western Europe. And that makes the investment more attractive. Next, timing problem. Okay, so in this situation, we can just see that they have the same outlay, but for product development, the cash flows are lower initially than increases with years that pass by. Whereas for marketing campaign, there are already inflows at the early stage and it decreases at year 5. This is a timing problem because when we compute now the NPV, it's really possible that one project would excel since they have already greater inflows when the time that the discount rate is at the highest in terms of the factor for present value. I'm not talking about the rates that will be used because the discount rates normally would be same with the projects having similar nature. So I'm talking about the present value factors when the discount rate has been used in the project. So we can just see here that the IRR is 14.1% and 15.9%. So if we think of priority, we would be checking this one first. Then the NPV in terms of the higher, so the product development would result to higher amount. Therefore, we will consider this first. See, there's conflict between NPV and IRR, but NPV should be prioritized. All right, as said. So we can look into this in a graph form. This is again the cost. This is again the present value of cash inflows. And these are the graphs by which the two would cross zero. The portion above the horizontal line, the cost, would be the point wherein the shareholders' wealth would be maximized, and the lower would be not maximized because negative. And then these are the IRRs respectively. And then the IRR respectively of the two, 10% and 12.5% are the respective rates in the project. Let's check. Although it's not given. It's not given like what rates used. Probably these are the hurdle rates or the cost of capital used in the given project. So we can just notice that the IRR is higher than the respective particular cost of capital. I guess this is the green line. Product development, its rate is 10%. So this is 14.1% higher, so we will accept the project. If we have like limited capital, of course, we will have to accept everything. IRR here is 15.9%, this one. And then this particular 12.5% is directed towards the violet one, 15.9% higher than 12.5%, so accept the project under IRR ruling. And then there's a note here. Because of the differences in the timing of the two projects' cash flows, the NPV for the product development proposal at 10% exceeds the NPV for the marketing campaign. Of course, we can see that here. So that's why we will accept first, if we have limitation of capital, the product development first. Then this is the last ratio, which is profitability index, wherein the formula is the present value of the cash inflows over the cash outflow or the investment. So ruling, accept if PI is greater than 1.0, because that is the point that really NPV is greater than 0. And that's why the PI would be in unison normally together with the NPV decision. So for Western Europe, that's 1.3 higher than 1.0, which is obtained by this one divided by this one. PV of cash flows over outlays. And this one also, PV of cash flows over outlays, 1.5. So meaning we'll accept the two projects. If independent, right? But if we have limitation, accept Southeast US first. Then like IRR, PI suffers from a scale problem, yeah, because it's going to depend also the amount of the investment as well as timing for the cash flows. Okay, these are again our rates that we are going to use. In fact, it becomes 6 already, as opposed to 5 that I've said. All right, so thank you very much for listening to our discussions. Hopefully you learned something about the rates. So if ever you were not able to pay attention to much details, you can always go back with them anyway. And I'll see you next time for another item or discussions involving capital budgeting and other financial management subjects. Bye for now and God bless.